Good afternoon. I'm Professor Pat Murphy, co-chair of the Institute for Ethical Business Worldwide, and I'll serve as your MC for this afternoon. I'd like to welcome you all to the 9th Annual Theodore M. Hesburgh Award for Business Ethics and the Frank Cahill Lecture in Business Ethics, co-sponsored by the Center for Ethics and Religious Values in Business and the Institute for Ethical Business Worldwide. Both Father Hesburgh and our recipients will be introduced shortly. We have a few guests that I'd like to introduce. Audrey Grzywinski, Ron's wife, who came down from Chicago today. Karen Weigert and Bill Dewey of ShoreBank, and also Notre Dame alums, right, with us today. And Kathleen Sweeney, who's here representing the Cahill family, South Bend resident, niece of Frank and Marty Cahill, and my wife Kate, who's Father Hesburgh's chauffeur, important role to play today's event. I'd like to recognize, I don't think she's in the room, Deb Cook, our administrative assistant, who did much of the behind-the-scenes planning for today, and thankful to Deb for all of her hard work. Just give you a brief outline of what we're going to do in the next hour. I will start by introducing Father Hesburgh, and then Josh Koenig, who nominated Ron and Mary for this award, will introduce them. We'll have a few pictures here, and then I'll come back and tell you about the Cahill lecture, and Ron will deliver that, the social entrepreneurship and ethics in banking, and we'll have a short speech by Mary, and then we'll open it to Q&A, questions and answers. So let's start with Father Hesburgh. The College of Business established the Hesburgh Award in the year 2000 in honor of Reverend Theodore M. Hesburgh, CSC. He was educated at Notre Dame and the Gregorian University in Rome, excuse me, and he was ordained a priest in the Congregation of Holy Cross in Sacred Heart Church in 1943. Those of you that are good in math, you add that together. This year he's celebrating 65 years in the priesthood. Congratulations, Father Ted. At the age of 35 in 1952, he was named the 15th president of Notre Dame and served in that capacity for 35 years until 1987. Since then, Father Ted has assumed his role as president emeritus and continued to serve Notre Dame as a senior spokesperson and goodwill ambassador. As most of you know, last May he celebrated his 90th birthday, and in fact, just 1 year ago today, April 22nd, 2007, he was saying a mass for our business students and afterwards attending one of his many birthday parties. Since Pope Benedict was just in the United States, I think it's appropriate to mention that Father Ted has served 4 popes in his distinguished years, 3 as a permanent Vatican representative to the International Atomic Energy Agency. He has held 15 presidential appointments over the years to commissions on civil rights, campus unrest, third world development, and immigration reform, to name only a few. At the same time, he remained a national leader in the field of education, an achievement reflected by his more than 150 honorary degrees, and yes, he is in the Guinness Book of World Records for that. He is a recipient of the Medal of Freedom, the nation's highest civilian honor bestowed on him by President Johnson in 1964, and the Congressional Medal of Honor was awarded to him by President Clinton and congressional leaders in 2000. In sum, he is considered by all to be one of the most influential figures in higher education in the 20th century. As many of you probably do not know, he was asked to sit on the board of directors at Chase Manhattan Bank by David Rockefeller and was the first priest ever sit on a corporate board. As he tells it, Rockefeller assured him that he didn't expect Father Ted to learn high finance or become an expert in it, but become the conscience of the board. And Father Ted has also been a confidant to many business leaders over the years. So it's appropriate that we recognize his leadership, service, and integrity with this award. I'd like to end with one of my favorite quotes of Father Ted that I think relates very closely to our recipients today. He said, "My basic principle is that you don't make decisions because they are easy. You don't make them because they're cheap. You don't make them because they are popular. You make them because they are right. So I'd like to call up Josh Koenig, who will introduce and who nominated Ron and Mary to properly introduce them, and we'll continue on. Josh?
Good afternoon. Today I have the honor of introducing two individuals who are truly deserving of the Father Theodore Hesburgh Award, Ron Grzywinski, the chairman of ShoreBank, and Mary Houghton, the president of ShoreBank. Our purpose today is to recognize and honor the work they have done in revitalizing economically disadvantaged neighborhoods and making the dream of business and home ownership possible for many people in those areas. ShoreBank began operations back in 1973 when Ron and Mary, along with two other entrepreneurs, purchased the South Shore National Bank in Chicago. The owners of the bank wanted to sell because of the quickly changing social economic conditions on the south side of Chicago. The community was transitioning from a middle-class community to a troubled, poverty-stricken community. At the time, economists and many others predicted that South Shore would become one of the worst slums in Chicago within 5 years. Many companies disinvested in this area because of this trend, but the South Shore Bank was not allowed to leave because of regulatory issues. Therefore, the bank was put up for sale and went unsold for 2 years. No banks or investment firms believed the bank had any chance of profitability because it was in a failing neighborhood. Finally, the group led by Ron and Mary purchased the bank with the idea that their core business could have a purpose other than just making money. They believed that an effectively run commercial bank could restore and strengthen neighborhood economies and be profitable as well. Because of this belief, they decided to take a chance and invest in this struggling neighborhood, and it paid off. The community of South Shore was revitalized, and the foundation was laid for the future success of ShoreBank. Throughout the 80s and 90s, ShoreBank continued to grow and now has more than $2.1 billion in assets and a presence in Cleveland, Chicago, Detroit, Ilwaca, Washington, Portland, Oregon, and Michigan's Upper Peninsula. Even though ShoreBank has grown, it has not changed how it does business. To date, in South Chicago alone, ShoreBank has invested nearly $3 billion for the financing of more than 52,000 affordable housing units. But they're not about to stop there. Now in the midst of the subprime mortgage crisis, ShoreBank is reaching out to low-income homeowners who are being threatened by exploding adjustable rate mortgages and helping them to refinance with stable fixed-rate mortgages. Currently, they have assisted low-income homeowners in refinancing over $4.5 million in loans. The Hesburgh Award is presented annually to business people who, through their business endeavors, have made a sustained contribution to social, ethical, and environmental progress, have shown great moral courage in those endeavors, and have acted consistent with Father Hesburgh's vision and the Notre Dame values of building community and sense of purpose in one's organization, as well as the building and maintaining of an ethical organizational culture. Ron Grzywinski and Mary Houghton have been leaders at ShoreBank for over 30 years, and in those years, their moral courage has been demonstrated in their leadership and actions to sustain and invest in communities where critics and other financial institutions have said there is no chance of profitability. Their courage has been consistent with their vision and sustained in the face of genuine adversity. Ron and Mary's leadership and the everyday business activities at ShoreBank have done a wonderful job of creating a culture where personal dignity is respected, personal and corporate integrity is valued, and high ethical standards are demanded. Ladies and gentlemen, please welcome ShoreBank's Chairman and President, Ron Grzywinski and Mary Houghton.
And then we'll get one with Josh. Yeah. Josh? I can. Okay. I'll put that on later. Okay? Next, I want to talk about the Frank Cahill Business Ethics Lecture Series. Was established after Frank's untimely death from cancer at age 59. Frank grew up in Syracuse, New York. Many of you know Father Ted grew up in Syracuse, New York. And from the time he was a small boy, he dreamed of attending Notre Dame, and his dream became a reality. Graduated from Notre Dame, and there's a long-time connection between the Cahill family and the university. He has a son and a grandson who are alumni, and we're just sorry that his wife Marty could not be with us, or any members of the family, direct family today. But just to tell you a little bit about Frank Cahill and why we honor him with his lecture series. After earning his BS in commerce, Frank enjoyed a very successful career as an executive in the trucking industry and retired as an officer of Roadway Express after a number of executive positions. Integrity, character, and ethics were cornerstones of Frank's life and career. Throughout his nearly 40 years in business, Frank experienced firsthand the challenges that a commitment to ethical business practice can introduce in the pursuit of both personal and professional success. Frank recognized a real need to introduce to young professionals to some of the ethical considerations they'll face in the business world. According to one of his sons, Frank had a lifelong commitment to teaching ethics through action. And the Frank Cahill Business Ethics Lecture Series focuses on those core principles of integrity and ethical behavior in the business environment and provides the Notre Dame community with a lasting memory and reminder of Frank's exemplary qualities. So please join me in welcoming back Ron Grzywinski, who will deliver the 2008 Cahill lecture for us this afternoon, Social Entrepreneurship and Ethics in Banking. Ron.
Well, good afternoon. I think I want to start by saying what an honor it is to share this platform with Father Hesburgh. We were thinking a few minutes ago, we were talking about what year you first became president here, Father. And it happened to be in the year that I was a sophomore at Mount Carmel High School. And it's been a very long time. Then more recently, sort of current under that scale, you and I shook hands in 1962, which I'm sure you remember, as I was leaving a football game here. So anyway, it is a real honor and a pleasure to be here. I want to thank my wife Audrey for joining us, and for my colleagues Karen and Bill also to join us. Two alums, one of whom grew up here, Karen, and is really a product of this community. I think it's also interesting that when Mary and I were leaving our office this morning, literally just as we were leaving, we got an email from one of our directors, Nick Racinas, who runs the Joint Center for Housing at Harvard University, and he was the FHA commissioner during the Clinton administration. He had seen the press release that had gone out last night, and he said, congratulations. But then he added, it is really nice to see business and ethics in the same headline. So thank you very much. It is just wonderful. We also want to thank Josh. Thank you very much, Josh, for nominating us. We wouldn't be here otherwise. And Pat and your colleagues at the Institute and the Center. I think also it's Mary and I are both products of 16 years of Catholic education. Spent a lot of time with the Jesuits there toward the end, but I'm sure you'll forgive us for that at different schools. But it's just how much Father Hesburgh has contributed to the transformation of Catholic higher education over the years. And I don't think the New York Times was attributing it to you directly, Father, but last week when they talked about how Catholic education has changed so that it's less about indoctrination and more about inspiration. Maybe they were attributing it to you, but it seemed to hit the nail right on the head. Mary's the one who said that I'm delivering this lecture, but I do need to say that this is a joint lecture that we wrote together. Mary will make a couple of comments at the end, but these words are both of ours. So I think what I want to do this afternoon is to share a few thoughts about social entrepreneurship and an ethical choice for individuals and businesses. And it seems highly relevant today after what we are seeing during this past year about the results of predatory lending practices. And then keeping in mind today, April 22nd, is also Earth Day. It ought to remind all of us of the ethical responsibility that we have as stewards to the world for the generations that follow us. As we all experience every day in our lives, we are the beneficiaries of genuine entrepreneurship that has occurred over the generations and over the last several decades in particular. And we see the new products and the services that enrich our lives. Now, when my generation was growing up, the very idea, one couldn't even imagine, as an example, things like iPhones or global positioning satellites or miracle drugs. But because we all have witnessed the material benefits of entrepreneurship, people are turning more and more of their attention to social entrepreneurship as a way to create more for less that can benefit people and societies that have had fewer opportunities to lead a full, rich, and productive life. The men and women of ShoreBank, of whom Karen and Bill are just 2 out of about 500 people, they work every day to apply the best practices of social enterprise in the inner cities of Chicago, Detroit, and Cleveland, in the temperate rainforests of the Pacific Northwest, and the spent mining towns of the Upper Peninsula of Michigan, and in the villages and towns of Bangladesh, Afghanistan, Cambodia, the former Soviet Union, and nearly 40 other developing countries. As you've already heard, the ShoreBank story really begins in the 1960s, when 4 of us, Mary, myself, Jim Fletcher, and Milton Davis, we were all working together at another bank, and we started brainstorming ideas about how to reverse the decline of Chicago's inner city neighborhoods. Now, at that time, by day, we were acting as bankers. I was wearing my white shirt and tie and looking like a banker. But at night, after work, we would gather at the Eagle Bar, which was nearby, which is where all good ideas ought to happen, and we talked about ways that we could address the entire litany of problems that were dragging down urban neighborhoods. Now, at that time, we also had other experience because our colleague, now deceased, Milton Davis, was very active in the civil rights movement. Jim Fletcher before he joined us, was the Deputy Director of Citizen Action Programs, a major Office of Economic Opportunity program in the 60s. And Mary and I separately had experience working with nonprofit organizations. And at that time, what we really began to realize was how, when we worked as volunteers with not-for-profit organizations, we spent a lot of our time trying to figure out how to meet last week's or sometimes last month's payroll. Yet during the day, we were acting as bankers, making loans that other bankers said could not be made, or more importantly, repaid, and ours were being repaid. And we thought about why can't we bring those two sets of experiences together? So one of the problems that we talked about at the Eagle Bar and other times was redlining. And that was the practice then by which banks simply refused to issue mortgage loans or invest capital in entire neighborhoods that were considered undesirable. That was without reference to the people individually. It was just an entire neighborhood was redlined. Now, these neighborhoods were the same places in which banks were often collecting substantial deposits. One example is the incumbent governor of Massachusetts is the grandson of a man who worked at our bank, I'm getting ahead of the story, in 1973. But his wife, I think, saved probably every penny that the man earned in order to put Deval Patrick through undergraduate school and law school. But it's just a point about the capacity of people to save and try to control their own destiny. So the consequence of redlining back in those days was that capital was transferred from neighborhoods where it could do the most good to places where it could earn the highest return for the bankers. Now, when there is no capital available to invest, neighborhoods wither and die. And in those days, on the south and west sides of Chicago, in the 1960s and 70s, the combination of blockbusting and redlining was quickly turning vibrant neighborhoods into troubled ones. Now, for those of you who are old enough, and there aren't too many of us here this afternoon who are old enough, but this was a time of urban renewal, which often meant destroying communities and building high-rise reservations for poor people. It was a time of federal programs like Model Cities and the Great Society, but it was also a time of intense community organizing. We recognized that while government programs and community organizations had identified what the problems were and had important roles to play in responding to those programs, their structure, philosophy, and resources made it impossible for them to make a lasting difference by themselves. As first-hand observers of the Great Society, we understood that fixing the problems of urban decay would require a different kind of approach. As bankers, we believed that the key to rebuilding disinvested and neglected neighborhoods was to harness the mechanisms of capitalism for a social purpose. In other words, decaying neighborhoods needed local, self-sustaining enterprises with the independence of a capital base and the discipline of a profit motive. Essentially, these enterprises would operate in the gap between private gain and public good. And we imagined a new kind of institution to support those enterprises, a local development bank, a bank that could be tough-minded about loans and about borrowers, but one that could also satisfy the most demanding federal examiners and still make a profit by transforming underserved urban neighborhoods. At the time that we began looking for a bank to buy, the owners of the then $40 million South Shore National Bank decided that it was time to sell and move the bank downtown. The reason they made that decision was during the preceding 4 or 5 years, the neighborhood had gone through an almost complete racial transformation, going from a 100% white neighborhood to about an 80% African American neighborhood. And during that time, the bank, because it had no capacity and no ability to respond to those changing racial demographics and the values and the work habits of people, often in a nuclear family holding down 3 jobs between 2 adults, the bank lost about half of its deposits. And there was an entire pattern throughout the United States in those days that when racial change took place in neighborhoods, the banks that were there would appeal to the regulators. They would use euphemisms and talk about change in the economic condition of their neighborhoods, but they really meant racial change. And up until 1972, when the control of the currency ruled against the South Shore National Bank, to the best of our knowledge, no bank in the United States had ever been denied permission to relocate under those circumstances. Now, we were looking for a bank to buy, okay, and we knew the story, and we knew that that permission had always been granted. Unfortunately, there were 3 people in the South Shore neighborhood who were, as I like to say, were not as smart as we were, and they decided to fight. And after 2 public hearings in December of 1972, they won. Okay? And the controller of the currency, who regulates all national banks, said that the bank had failed to show persuasive reason for abandoning its service area. It's the language of the order. And it was 9 months later, on August 23, 1973, with a princely $800,000 in capital and a $2.25 million floating rate loan, we bought this failing bank. Our goal was nothing less than to prove our theory, and that is to demonstrate that a bank could do well by also doing right. We created ShoreBank to explore and demonstrate the ways in which private capital and the nation's banking system can be used to achieve social purposes. It is by necessity a long-term proposition to invest in the residents, but they really are the only ones who can build sustainable communities. As the new managers of South Shore Bank, our goal was to restore the South Shore community competitiveness by rebuilding the market forces that disinvestment had destroyed. Our approach focused heavily on maintaining, retaining, and rebuilding the built environment by and for the people who live there. We started lending to people who wanted to renovate the buildings that were in that neighborhood. We found the local entrepreneurial energy in the craftsmen who bought, renovated, rented, and managed first a 6-flat and then a 12-unit building and then a 24-unit building until what for them had been a sideline became a business, and what had been a community at risk became a stable community owned by its residents. Since then, for over 30 years, ShoreBank has demonstrated that local hands-on rehabbers can successfully buy, renovate, and rent the small multifamily buildings that predominate in most neighborhoods on Chicago's south and west sides. Buying, fixing up, and renting these buildings is a true entrepreneurial venture that requires appropriately structured financial products and skilled staff to provide them. I'm probably a little biased, but in this business segment, ShoreBank's record is unsurpassed. It restored normally functioning investor real estate markets in many of its priority communities through this lending. We now operate in Chicago in about 1/3 of the city, most of the south side, and a good portion of the west side. ShoreBank now has financed the purchase and rehabilitation of more than 55,000 units of affordable, unsubsidized housing at a rate of 3,000 to 5,000 units per year. Now, banks and mortgage companies provide most of the housing lending in the United States. However, they typically avoid the small apartment building sector. In a paper prepared a couple of years ago for the Millennial Housing Commission, the Housing Finance Task Force noted, and I quote, that financing for small multifamily properties, those of less than 50 units, is one of the most significant gaps in the mortgage industry. In some large cities, including Chicago, high concentrations of 5 to 50 unit apartment buildings coincide with low and moderate income neighborhoods, meaning that lower income renters and communities bear the brunt of the capital market gap. Without active lending for these buildings, owners must pay for renovation and upkeep out of pocket, and borrowers and sellers cannot create an active investment marketplace. This results in declining real estate values, disinvestment, physical deterioration, and ultimately community decline. The ShoreBank contribution is distinctive in this type of market. We have developed a strong market share and expertise due to our unique relationship-based lending. The ShoreBank product for multifamily loans is highly personalized and valued by the entrepreneurial customers that it attracts. Quality service, tailored to the customer and the project need, is a key differentiator from the competition and is provided at the onset of a customer experience. In some ways, ShoreBank acts as a feasibility consultant to our clients and provides no-cost advice to people who believe that they may have found an opportunity with the building. Additional advantages of the service we provide include fast processing, accessibility, and an in-house appraiser providing faster and typically lower-cost service. As is the case with other lines of business when approving a loan, lenders do not rely solely on standard valuation criteria, such as credit, debt service, and appropriate loan-to-value. A combination of 4 unique qualitative factors, the talent of the borrower, the right fit between the borrower and the project, the right place, and mission orientation, are no less important to the approval process. These factors have driven ShoreBank's success in this line of business. In over 30 years of doing this, our real estate loan portfolio has averaged a loss of 18 basis points per year. Now, if you don't walk around campus all the time talking about basis points, okay, that means 18 1/100ths of 1% per year has been the average loss rate on these loans made in the inner city on the south side and the west side of Chicago. ShoreBank provides credit to those who demonstrate key characteristics of successful borrowers, including novice customers without a track record or substantial heavy balance sheets. As a customer evolves, so do the key advantages of borrowing from ShoreBank. No upfront fees are often attractive for those just starting out, while an experienced borrower comes to value the speed and ease of access to lenders. By providing 100% of the rehab costs and underwriting loans based on cash flow are significant value propositions across the board. But the neighborhood really needed more capital than could be raised locally. In order to attract capital from beyond the neighborhood, we created, many years ago, development deposits. It was a trade name that we created, and solicited support at market rates throughout the United States. We essentially promoted our FDIC-insured deposits, plain, ordinary, vanilla bank deposits, the same as every other bank in the country, at market rates of interest. And through the magic of FDIC insurance and solid underwriting, we were able to transform those deposits into development credit for the neighborhood. That savings program appealed to people who wanted to invest their savings for community development and still earn a competitive rate of return. The success of these development deposits, along with the help of local depositors and 67 equity shareholders, helped ShoreBank to reverse the flow of capital and begin the long process of neighborhood regeneration. And last fall, we, or Karen, introduced ShoreBank Direct. And you can go online at www.sbk.com. Got it, okay. We believe that this is the only internet-based bank savings account that supports community development and environmental sustainability. Karen obviously got a reasonably good education here because in just 6 months, with hardly any advertising, we have already opened over 900 new deposit accounts with balances of $12.5 million. And those deposits, or am I a little behind? Close, okay, close. Anyway, it's been off to a phenomenal success. It just shows an enormous amount of support for this activity. In the 1990s, ShoreBank began to focus on building not only economically sustainable communities, but communities that are also environmentally sustainable. As we all know, this is an increasingly important concept as energy prices increase and we learn more and more about the effects of global warming. The process for ShoreBank began through a partnership with EcoTrust, a nonprofit organization in the Pacific Northwest that demonstrates the ways in which economic and ecological systems are interdependent. Our goal, similar to our initial efforts to close the gap between private gain and public good, is to build a bridge between conservation and economic development. Today, ShoreBank Pacific, the first environmental bank in the United States, and ShoreBank Enterprise Cascadia, our bank and not-for-profit affiliate in Oahu and Seattle, Washington, and Portland, Oregon, are providing resources and leadership to enable long-term growth and success in the region's organic farming, fishing, and timber industries. In Chicago, we are the first bank in the Midwest to offer innovative financial services and products that encourages property owners to incorporate energy savings and sustainable design for the building and renovation of commercial and residential buildings. In Chicago, Detroit, and Cleveland, we strive to finance the restoration, acquisition, and the adaptive reuse of existing housing stock and commercial buildings, including some of the region's most historic structures. We try to do that through rehabilitation rather than new construction, which uses dramatically more scarce resources. Taken all together, ShoreBank Corporation today has assets of over $2.3 billion and more than 500 employees. Over the years, we have demonstrated that serving the triple bottom line goals of profitability, community development, and conservation is both realistic and achievable. We have invested more than $3 billion in business across the country and have created approximately 11,000 jobs for local residents. ShoreBank has thrived for nearly 35 years by specializing in specific local markets for the long term. Underwriting is done in a face-to-face meeting so that qualitative judgments can be made about character and capacity. The bank is not interested in financing speculation, but is interested in using its funds so that residents can acquire property and build their net worth. This is, after all, the way in which most Americans build wealth. Long ago, a very good friend, and now deceased friend of ours, of Mary's and mine, Al Raby, who was a community organizer and co-chairman with Dr. King in Chicago back in the late 60s, reminded us that poverty is really the absence of choice. When you lose a job or have medical bills but no financial cushion, your choices are very narrow. With enough money, enough capital, enough savings to ride out a storm, your choices increase. Now, ironically, the neighborhoods that have been restored during the past 30 years, as mortgage credit became readily available to minorities, were the very same neighborhoods that during the past 3 to 4 years became the targets of unscrupulous brokers who saw a rich opportunity to originate predatory mortgage loans. Advances in computer-based loan processing, securitization of mortgages, and internet-based communication systems all made new methods of mortgage origination possible. These changes occurred very quickly and were often exploited by unregulated mortgage and investment businesses. As we all know all too well, several million homeowners now face the prospect of losing their homes. The problems are nationwide, but speculative markets and minority neighborhoods have been the hardest hit. We do not know the end of this story as yet. At its worst, Mrs. Smith, who bought a home in 1988, but loses her job in 2008 and cannot keep up her mortgage. For the Jones family that finally bought its first home in 2005 with a mortgage that it thought it could afford, only to see the monthly payments double, will end up losing everything. But we don't know how many Mrs. Smiths and Mrs. Jones will quietly be able to ride out this storm. There is much more resiliency in this community than many people realize. So looking at this recent history of predatory lending, what are some of the ethical principles that we, as a society, should learn from this rampant demonstration of fraudulent greed? I have counted at least 7 lessons, and there are probably more. First, a lender has an obligation to both his or her organization and to the borrowers to make loans that the borrower has a reasonable ability to repay. This most fundamental principle of banking was ignored for several reasons. Lenders went into an originate and sell mode with few checks on what they were selling. Regulators did not adequately assess the risk of new, complicated financial instruments, and regulations did not provide adequate authority to monitor and control the excesses. Lenders bought loans from other parties that were operating only on a fee-for-service basis and had no interest in the sustainability of the loan. And borrowers, generally encouraged by those selling them the loans, lied about their capacity to repay. The second lesson is that many of the parties interacting directly with borrowers were compensated on a basis that gave them an interest that was inconsistent with the borrower's interest, and they acted in their own selfish interest and misled the borrower into believing that they were acting in the borrower's interest. This is the clearest with mortgage brokers, who were often paid higher fee income the higher the interest rates that they were able to squeeze out of the borrower. But real estate brokers also were primarily interested in getting the highest price available under the fastest possible sales conditions, even if the house was more than the borrower could afford and the loan was suboptimal. 3, it is pretty clear that brokers and lenders of many stripes took advantage of borrower inability to understand complex mortgage instruments, as well as borrower self-delusion. The fact that the Federal Reserve Board is now writing a rule that says you cannot advertise rates in one language and put the fine print only in English is just an example of the extreme lack of respect for the truth. This was undoubtedly worse in lower income, elderly, and minority communities, although it went throughout the spectrum. 4, securities firms, unlike mortgage brokers, actually have a statutory suitability obligation, and issuers are supposed to disclose information for the protection of investors. The disclosures were impossible to understand, even when the information was technically included, and investments were clearly sold to borrowers, like small municipalities and pension funds, that may have technically been sophisticated, but could not possibly have understood what they were buying. And even if they did understand it, it was not suitable. When the initial investor was capable of understanding, like a big mutual fund, shares were ultimately sold to those who didn't have a clue. The fact that many relied on ratings put out by entities paid by the issuer for these ratings did not help. 5. An entire generation of regulators believed that their obligation was to let the market flow most efficiently rather than to reach out and protect consumers. 6. I think it is fair to say that borrowers have an obligation to tell the truth about their ability to repay to lenders. In fact, it's actually a perjury violation not to for most home loan applications. There is very good evidence that truth-telling had taken an extended holiday. And number 7, everyone was hustling to make lots of money without thinking or caring about who was left holding the bag when the music stopped. If I recall correctly, it's been a long time since I've been in school, greed is one of the 7 deadly sins, a fact that is no doubt well known around this campus. Today, the ShoreBank Rescue Loan Program is reaching out to an estimated 10,000 households on the west and south sides of Chicago, to people who have mortgages with interest rates that will adjust significantly upwards between now and the end of next year. Most amazingly, 80% of the people who we are interviewing for loans under this program, these are the people who have these very high rate, adjustable rate mortgages. 80% of the applicants have qualified for conventional loans, reinforcing the fact that the hard sell promotion of these high priced mortgages was indefensible if the point is providing your customer with the most suitable product on the market. Now, isn't that a quaint thought, to think about providing your customer with something that's suitable? ShoreBank today is making about a loan a day, but hopes to be making 3 loans a day by year end. Would that all banks in the country would do the same and fulfill their obligations under the Community Reinvestment Act to, quote, meet the credit needs of their communities. So as you can see, banking and ethics should be, could be, and I'd like to believe used to be, joined at the hip for the greater good of the nation, rather than be disconnected, unvalued, underregulated, thus permitting the selfish and the powerful to fill their inflated wallets as they exploit those of lesser means. If ever we hope to build a fair, just, and equitably productive nation, we must abandon personal greed as a dominant value of the society and begin to behave as if we truly are each other's keepers and not each other's exploiters. And so now, Mary, if you want to come and say a couple of words about how ethical behavior is central to the fulfilled life, it's all yours.
No, I just want to say that we could take a few questions if there's a few minutes. And the story is really a story about what an interesting profession development banking is and will be for decades and decades to come. That's it, Ryan.
If you'd use the microphone, that way we can get it on tape. Who'll be first?
When you initially started with the purchase of the bank several decades ago, how long were you making losses on the loan? How long did it take you to turn positive on profits?
I think it was essentially in the first year. Because we bought an existing bank, which had been profitable before it was acquired, the first year was almost break even, but after that we always made a profit.
The first year we sold we had a large portfolio of tax-exempt mortgages. We deliberately sold those because we realized there was no way we were going to be able to utilize the tax advantage. And that year was an outbreak. That was a loss year. And that was calendar year 1974. Since that time, the bank has not had any operating losses.
Now, if you'd asked how many years before we made as much money as our peers, that would have been a harder question.
And the other lesson that we learned is that, I think the other lesson that we learned, I sometimes like to think that we were smarter when we were younger, because when we were invited by Governor Clinton to go to Arkansas and create a rural development bank, and then in Cleveland and Detroit, there were in Arkansas, we were able to purchase a bank. In Cleveland and Detroit on the West Coast, we had to start new banks. And so those were much more difficult startups and took quite a few years before those banks became profitable.
Thank you.
Ron, the result of this unethical behavior, or I guess the cause of it, as I heard you describing it, seemed to be the reward systems and the incentives that generated this kind of behavior. If I could flip that around a little bit, in your experience, are there incentives and rewards that would generate ethical behavior? If you were to take that statement that you elicit the behavior you reward, are there ways to more positively generate that kind of ethical response that you'd be looking for?
There's a saying around, before I respond, there's a saying around ShoreBank, if you ever get two or more ShoreBankers together at the same time and ask the same question, the number of responses will be equal to the number of people present squared. Okay, so you might hear Mary and I disagreeing quite a lot. I don't know that there's a system. Okay, ShoreBank creates a value system in the organization. I mean, it's been going on for a long time, and we were extremely conscious about doing that at the beginning. And you do it in all the ways that I think leaders do. Okay, by setting example in a variety of ways. By making sure that there's ethical behavior across the board, et cetera. We could ask in a moment our two colleagues here to respond. We'll see what answer they give. But I think other things that we have built in, which are not directly an answer to your question, is that there are incentive compensation systems within ShoreBank, and those incentive compensation systems require that there be performance on not just earnings, but also on development performance and conservation. It's truly a triple bottom line company. So the bank could, or the holding company, any unit, could produce earnings that are just off the chart, okay, in terms of reference to budget or anything. But if the goals are not met for development or conservation outputs, it sort of becomes interesting, but there's no bonus, okay? But on the value system, I'm going to ask Karen and Bill. Why don't you comment? I mean, let's see. Karen's been with ShoreBank, about a year and a half, 2 years now? And Bill's been about 2.5, 3 years? So, time flies. So how did you respond?
Nothing like a cold call when you're out of school. I actually think Ron's anchor point about the bonus structures is critical. We sit around at the bank in senior management meetings and we actually talk about this because there really are three things that are measured and your bonus sits on that. So you kind of have to pay attention. One thing that's also very interesting is then how that filters down. And I don't work on the mortgage side, but my recollection is that there's work there where some staff are more heavily salaried than they would be in a peer institution to incent for longer-term behavior than you would be if you were commission-driven on some of those same types of roles. So it is very interesting when you get to nuts and bolts of how you get paid. More broadly, though, it's really a question of what kind of people do you hire, how do you nurture them, and what are the kinds of things you actually talk about at work. And in an institution like ShoreBank, you're always talking about anchoring in communities, what are the long-term things that will strengthen communities, and then what are the types of things that can bring environmental sustainability into these same areas that might be underserved. So I'd go from the compensation structure all the way down to then how you hire and then promote skill development at the staff.
We at ShoreBank International, the international consulting arm of ShoreBank Corporation, recently had our annual international meeting in Shanghai. And I was giving a presentation about one of the things we do in our work. And I was chided by Ron because I did not make explicit that among the things why we do what we do is to alleviate poverty, to promote social inclusion and the like, which is all a way of saying that the mission comes first. And if I've heard that once, I've heard it many times. And it's, I think Ron would say, it can't be merely implicit, it must be explicit. We have to repeat that to one another and make it part of everything we do every day.
Ron, can I add something?
Yeah, please.
I think that people really like the chance to innovate and to contribute. That's a part of work, and they're very proud to have meaningful work, and that's sort of I think that's our huge recruiting advantage that we have. Is people say, well, if I come here, my work has purpose beyond the job.
I might add one last point as we're waiting for the next question, is that ShoreBank is owned by a combination of charitable foundations, national church organizations, a couple of large banks, and a couple of large insurance companies. The ownership, particularly by the foundations and the charitable organizations from the very beginning, helped to set a tone for what the place was all about.
A few of the MBA students here this year have been working on a housing project with Hurricane Katrina, and it's being led by Digger Phelps, former basketball coach here. And one of the biggest challenges is finding families who can sustain a loan for a house, even if it's at a very low cost. What is your take on what's going on down in New Orleans right now and the revitalization efforts in terms of housing?
I'm really sorry, but because of the microphone, I just couldn't hear the bulk of your question.
Just what is your take on the revitalization efforts that are going on in New Orleans right now, and what do you think further can be done?
So since you were just there.
I was just there a week ago, but only it was to talk to a group of people who are working on that issue. In the end, I don't know that I know enough. ShoreBank manages a company called NCIF, National Community Investment Fund, and it makes equity investments in local development banks in the United States and also minority banks. And there are investments in 2 banks right now in New Orleans, and those investments preceded Katrina. If you talk to people who are working there, the universal complaint is that resources are not flowing fast enough, that there aren't enough things that are being done. There's probably a fair amount of truth to that. On the other hand, there are good examples of other work that is going on. I've saying to Pat walking over here, I've been on the board of what used to be called the Enterprise Foundation, now Enterprise Community Partners, probably for 25 years. And they've been very active in New Orleans doing a lot of work. Other national organizations are doing work, and there are a lot of local people doing work. My own sense, but I really wouldn't want to be quoted because I don't know enough, is that things are happening that everybody would like them to move much more quickly than they are, that the flow of public monies has to go through different government regulatory processes. They're probably not as efficient as they could be. If you stay downtown, it all looks like nothing ever happened. Okay, but a year ago we were with the chairman of one of these banks that I mentioned. Our entire NCIF board was, Mary and myself, and we drove around and saw some really bad stuff. We did drive through the 9th Ward. Most of the houses were gone, but there were still a few houses that were just straddling streets, okay, that they just hadn't been moved yet. A year ago, there were no grocery stores open in a very, very large area, but there was a Home Depot store that was open for obvious reasons. So I think things are happening, but not fast enough. There are a lot of people working there with a lot of energy. And if I had to, if I was going to bet, I'd probably want to have a little more knowledge than I have. But if I had to bet with the knowledge that I have, I would bet that things will come back, okay, and that the demographics might be a little bit different, but it's not going to be, it's going to be a diverse city, I think, in the way that it had been. But do you know anything? That's the best I can do. Sorry.
One last question.
If I could ask two. One has to do, has your idea caught on? You've been in business for so many years, and it's such an attractive idea. Aren't there other banks involved in this kind of work?
In the U.S., there are about 50 banks that have gotten certified by the Treasury Department as community development banks. There are about 250 community development credit unions, which would also be in the same business. And there are probably 700 large and medium-sized loan funds that are also in the business of financing housing and entrepreneurship. Internationally, there are now 200 regulated banks that are providing microfinance, which has been a phenomenally interesting international development. And there are maybe a handful of institutions that are broadening out into both small business and housing finance from microfinance. So I think it has grown slowly, but that it is a very serious business model which has staying power for the very long term that's required to make real change. But it's also a huge regulatory burden that you have to put up with.
Okay. I want to just add, totally agree with all that. Just add a couple of points. There are many ways in which one never knows where opportunities will lead. Okay, and Mary's reference to the CDFI legislation. We were invited by Governor Clinton in '85 to go to Arkansas. We never owned the bank, but we raised all the capital. And we ran it for 8 years, and he became aware of what the potential was and began to think of it as a model. And when he became president, which we absolutely had no idea would ever happen, as a matter of fact, I thought it never would happen, okay? But he did. He became president, and he introduced the CDFI legislation, which has been an incentive to cause others to do this sort of thing. It's not a model in which investors are going to get very rich, or at least nobody has figured that part of it out yet. You've got to be sustainable. I often think that this is the only job as an adult that I've had for more than 3 years, okay? And it's now 35. Maybe I got lazy and decided to stop looking, but it's also the job is interesting because we have the shareholders of ShoreBank have all invested primarily for the purpose of doing development, okay? And every offering document, every offering circular has stated explicitly that the purpose of their investment is not to maximize return on capital, but rather is to do development. So Mary and I and the other 500 employees of ShoreBank essentially are working for those shareholders. At the same time, the entire organization is regulated by the Federal Reserve Board and then by banking regulators at subsidiary levels. They're under the law, they're obligated to regulate banks to high standards of safety and soundness, which includes profitability. so that we as managers, everybody in ShoreBank, we're on a daily basis satisfying both masters, okay? And if we fail at one, we're finished. And I think that's what makes the job interesting, but it also does not attract large amounts of capital easily. The other thing I would add is that Mary and I were lucky in that we got invited in 1983 to go to help this guy in Bangladesh who had some crazy idea about making loans to poor village people. That was Muhammad Yunus, who won the Nobel Prize in '06. And for 10 years, Mary and I did all the financial feasibility work and helped them to raise about $170 million, probably more than that. But we got involved at the very beginning of the microcredit phenomena. And what's been very interesting, I think, there is, and we have a number of companies in ShoreBank now, Bill's company, that would take the rest of the evening if I went into the detail, works in about 40 countries, okay? Sometimes providing technical assistance, sometimes investing. And what we're seeing there is much more interest in people trying to start what become much larger systems. I mean, so that, BRAC is one of our clients, still our clients, has about 5 million members in just Bangladesh, plus we're helping them raise capital to expand in Africa. Grameen is another 5 million members. They become very large systems. And through some of our companies, we do find much more entrepreneurial energy trying to start these kinds of vehicles. It's really quite interesting to watch. The second question.
Good. In terms of today's problems, I was surprised at your numbers in terms of the ability to convert adjustable to fixed mortgages. They seem quite high. What are you doing that other people aren't? Are you accepting smaller margins? Or, I mean, it seems like the solution I hear so much about, but it seems to be meeting barriers.
I think all that we're doing is spending a lot of time in a personal interview and getting to know a family and thinking about their debts and their history and trying to do the deal. And so that's a very old-fashioned kind of underwriting. And I think we're building up sort of unusual experience that we know this data point now that 80% are approvable. That's all we know right now.
When it's all said and done, we are really just old-fashioned bankers. Okay, I'm serious. Okay,
we should have heard more.
It's not a commercial. We don't even do it as a commercial. It's just getting to know the borrowers, getting to know the community, and doing it that way.
It's a great way to. Thanks to Ron and Mary for a wonderful presentation, and Father Ted for being with us today, and Josh for your excellent nomination. And thanks to everybody for coming, and I'm sure Ron and Mary to answer any other questions people might have. And thanks again, and we stand adjourned.